C3 die stocks are still running, but the real question is bigger than one chart. Can the entire semiconductor chain justify what investors are pricing in? The chain starts with ASML holding machines, moves through Taiwan semiconductor manufacturing, then lands in Nvidia, Advanced Micro Devices, Broadcom, Qualcomm, ARM Holdings, and the cloud buyers. Microsoft, Amazon, Alphabet, Meta, Oracle, OpenAI, Anthropic, and Enterprise C3. Users are turning chip demand into a capital spending race. A press estimate puts big tech capital spending plans near $725 billion in 2025 billion in 2026, which makes the payoff question impossible to ignore. The market is no longer pricing only chip scarcity. It is pricing a full C3 die factory system, where tools, wafers, servers, power, and software adoption all have to work together. The weak point is sequencing. Cloud capacity arrives faster than paying customers. The same capex that created the rally can become the pressure point. This video follows the money from chip tools to foundries, chip designers, cloud landlords, C3, users, and the power grid, then tests the valuation risk. The latest semiconductor heat check is not just Nvidia. The top 5 movers in this snapshot are Qualcomm plus 11.6%, onsemi plus 6.0%, Advanced Micro Devices plus 4.0%, Marvell Technology plus 3.0%, while the semiconductor ETF rose plus 1.5%. Qualcomm led the group, up plus 11.6%. Reminder that C3, iPhones, edge devices, automotive chips, and licensing can still matter beside data centers. Advanced Micro Devices rose plus 4.0%, and Marvell Technology rose plus 3.0%, keeping the C3 die accelerator and networking debate alive. Nvidia slipped to 1.9% in this snapshot, but its market value near $5. 22 still makes it the center of C3. Spending expectations. A one-day mover list is only the starting point. The better question is which companies have multi-quarter demand, pricing power, and earnings leverage behind the price action. That is why Nvidia and Broadcom stay in the conversation even when they are not the top 2 movers. They tell us where the strategic spending is going. Broadcom was roughly flat, but the custom C3 chip story is why it belongs in this video. Its market value sits near $1.96. The danger in this theme is treating every C3 adjacent stock as the same trade. A toolmaker, a foundry, a chip designer, and a cloud landlord deserve different multiples. On the snapshot, Qualcomm screens near 22 times forward earnings, Advanced Micro Devices near 36, Broadcom near 23, and ARM Holdings near 100. ARM Holdings is the cleanest architecture royalty story. But the stock near $306.51 asks a hard question. How much future C3 profit is already paid for? Broadcom gets a different debate. Custom C3 silicon, networking, and software earnings give it more profit ballast, but the price to sales multiple still assumes execution. A low looking forward multiple can hide cyclical risk, and a high looking multiple can still work if earnings compound faster than expected. The comparison is not mechanical. For viewers, the takeaway is to separate great companies from great entries. In C3 semiconductors, both can be true at different prices. For this trade to hold, revenue must show up faster than capex fatigue, power constraints, and customer pushback on C3 usage costs before Nvidia, Broadcom, or Advanced Micro Devices can ship the newest C3 chips. ASML Holding has to sell the lithography tools that make advanced nodes possible. ASML Holding's 2026 guide calls for 36 to 40 billion euros of net sales. That range matters because high-end chip supply cannot simply appear overnight. Taiwan semiconductor manufacturing turns those tools into real production capacity. For January through April 2026, TSMC reported end-tone $544,829 trillion in revenue, up 29.9%. If TSMC capacity gets tight, the impact does not stop at one chip. It touches Nvidia accelerators, AMD chips, Apple Silicon, Broadcom Custom Silicon, and the whole C3 hardware queue. Advanced chip capacity is not a light switch. Tool orders, fab construction, qualification, yield improvement, and packaging capacity can take years to line up. TSMC concentration also keeps geopolitics inside every C3 chip valuation. The market pays for capacity, but it also discounts supply chain fragility. That is why the supply chain matters. The companies closest to real bottlenecks can protect pricing power even when the market argues about valuation. Nvidia remains the center of the C3.ai accelerator market because training clusters and inference deployments still revolve around its GPU ecosystem, software stack, and networking attach. In fiscal 2026, Nvidia reported $215.9 billion of revenue. In the fourth quarter alone, its data center revenue was $62.3 billion. Advanced micro devices is the key challenger because every credible alternative gives cloud buyers negotiation leverage. The question is whether competition pressures Nvidia margins or expands the market. Broadcom is not just Wi-Fi and networking. It reported $8.4 billion of C3.ai semiconductor revenue in its latest quarter and expected $10.7 billion the next quarter. Training clusters are only as useful as the network that connects them. That is why Nvidia networking and Broadcom switching silicon are central, not side stories. Nvidia's moat is not just the GPU. It is the software ecosystem, developer habit, networking bundle, and the speed at which customers can deploy. If mega-cap cloud companies design more in-house C3.ai chips, Broadcom becomes a direct beneficiary, while Nvidia's moat has to defend software, networking, and speed to market. The next layer is Edge C3.ai owns PCs, cars, industrial sensors, networking chips, and embedded compute. That is where Qualcomm, ARM, Marvell Analog Devices, and Onsemi enter. Qualcomm's move points to a market that wants C3.ai on device, not only inside a distant data center, that can support chips, modems, automotive systems, and licensing. ARM Holdings is different because it sells architecture and royalties. If more C3.ai workloads move into phones, PCs, servers, and autos, ARM's royalty story gets more powerful. Marvell technology matters because C3.ai is not just math, it is moving enormous amounts of data through optical links, custom silicon, and networking infrastructure. If C3.ai spreads from cloud training into phones, PCs, cars, factories, and sensors, the chip opportunity becomes broader than one accelerator cycle. The edge market can be huge, but margins and replacement cycles are different. That is why Qualcomm, ARM, Onsemi, and Analog Devices should not be valued like Nvidia clones. Analog Devices and Onsemi remind viewers that the semiconductor cycle also touches autos, power management, industrial automation, and sensors beyond pure GPU headlines. The real demand engine is not a retail trader chasing a ticker. It is Microsoft, Amazon, Alphabet, Meta, Oracle, and C3.ai Labs signing up for enormous compute capacity. A press estimate puts 2026 big tech capital spending near $725 billion, with Microsoft and Alphabet each near $190 billion, and Meta up to $145 billion. That money flows upstream into Nvidia accelerators, Broadcom custom silicon, AMD alternatives, memory, networking, storage, TSMC wafers, and ASML holding tools. OpenAI says infrastructure is now the foundation for future C3.ai, and Oracle's cloud ambitions show how the GPU rental market has become a real strategic battlefield. Capital spending is a demand signal, but it is not the same as profit. Big tech still needs C3.ai products that customers use repeatedly and pay for willingly. The more servers companies buy, the more depreciation hits future income statements. That is why utilization, pricing, and useful workloads matter so much. The sustainability question is simple. Will customers pay enough for C3.ai software and inference usage to justify the hardware build-out already being priced into stocks? After the hardware comes the user. ChatGPT, Claude, enterprise copilots, developers, and even local C3.ai tools like Ollama all turn compute into real demand. The risk is that C3.ai usage gets expensive before revenue catches up. If customers push back, demand may shift from maximum performance to cheaper inference and efficiency. Recent reporting said Microsoft's engineering division stopped new Claude code licenses because of financial and strategic considerations. That is not a full Anthropic exit, but it is a warning. If buyers favor lower-cost inference, winners could shift toward custom silicon, optimized networking, ARM-based designs, and cloud providers that deliver compute more cheaply. Local models and tools like Ollama do not replace frontier training, but they show why some users will chase cheaper inference instead of premium cloud usage. If C3.ai buyers push back on usage costs, demand does not disappear. It shifts toward efficiency, smaller models, custom chips, and cloud providers with better unit economics. The question is not only whether C3.ai is useful, it is whether the economics are strong enough for every layer of the semiconductor chain to earn its valuation. CoreWeave and Nebius are not classic chip companies. They rent C3.ai infrastructure, which makes them leverage plays on GPU availability, utilization, financing, and customer concentration. CoreWeave reported 43 active data centers, more than 850 megawatts of active power, and $66.8 billion of remaining performance obligations. Every rented GPU cluster can support Nvidia demand, but it also creates a financial chain. Cloud buyers need high utilization to pay for the servers, leases, and power. Nebius sits in the same conversation. Investors are paying for future C3 capacity, but the risk is that build-outs arrive before utilization is fully proven. For GPU cloud companies, the magic number is utilization. Expensive clusters need customers running workloads consistently, not just headlines about capacity. The model can work, but it is capital intensive. Higher rates, lower utilization, or cheaper future chips can change the economics quickly. The cloud infrastructure trade is a spread between chip costs, power access, financing costs, and what C3 customers are willing to pay per token. The most underappreciated C3 bottleneck may be power. A data center is not useful if it cannot get reliable electricity, cooling, transformers, and grid interconnection. General Electric Vernova sits on the power side of the trade, with the stock near $1,038.74 and a market value near 27 in IB. Even if Nvidia sells the accelerators and TSMC makes the wafers, grid constraints can decide when a data center actually turns on. That pulls in cooling systems, storage, backup generation, natural gas turbines, transformers, and the less glamorous equipment that keeps C3 workloads alive. Power projects also face permitting, grid studies, transformers, turbines, and interconnection queues. Those bottlenecks can delay data center revenue even when demand is real. That is why C3 investors are looking beyond chips into turbines, grid equipment, cooling, real estate, and energy infrastructure. The semiconductor story starts with lithography, but it ends at the wall plug. Power cannot scale. C3 revenue cannot fully scale either. Here's the framework. First, who controls the bottleneck? ASML Holding controls critical tools, TSMC controls advanced manufacturing, and Nvidia still controls much of the accelerator ecosystem. Second, who has pricing power? Broadcom has custom silicon and networking, ARM has royalty leverage, and cloud providers have to prove they can price compute profitably. Third, who has earnings growth today, not just a future story? That separates proven profit pools from companies still dependent on financing and utilization ramping perfectly. Fourth, will customers keep paying? If C3 usage costs force enterprises to slow adoption, the market will reprice the weakest links first. The C3 semiconductor trade can keep working, but the winning stocks should be the ones with real bottlenecks, real earnings, and customers who can afford the compute. The next catalysts are earnings guidance, C3 capex updates, cloud utilization, TSMC capacity commentary, ASML holding orders, and whether customers keep paying for C3 usage. The final point is that this is not one winner and everyone else loses. The chain can support several winners, but not every valuation will survive. Follow U.S. Market News 24 for market-moving stock stories, earnings breakdowns, and the next C3 infrastructure update.